Good evening, everyone. Good evening. A big warm welcome to all of you. My name is Adam Harris. I'm one of the traders and analysts with Trade with Precision, and I will be your presenter this evening. So the first thing that I would like to do is to check if you can hear me. Is the sound quality good? I have green lights on my side, so I just want to check with you. If you can type into the questions box and give me some feedback on that, that would be great. Much appreciated. No need to be shy. And just confirm for me that you can hear me. So again, welcome all of you to this evening to the IC Markets webinar. And again, my name is Adam from Trade with Precision. So on my side, everything looks good. Thank you very much. Thanks for confirming that, Steve. Tonight, the topic we're going to be talking about is the sleeping giants, finding profitable trades with Fibonacci. So I'll keep an eye out. By the way, as I said, just type in any questions as we go. I'd love for this to be as interactive as possible, so please feel free to ask questions and I will try to respond to them as they come up. And so it seems as though the audio is good for everyone and it seems good. It's good on my side. So while I give you a moment to digest this risk disclaimer, there's just the one. I'm going to tell you a little bit about myself. So I am based in the City of London. I trade for myself, trade my own capital, and I trade for clients. That's not a solicitation, just to kind of give you some background. I am a trend-based trader. I think probably another way to describe it is momentum-based trading. I am both a day trader and swing trader. I used to do more swing trading, and actually these days I've had a lot more time. So over the last 2 years, I've probably shifted over to doing about 80% of my trading is day trading. So generally speaking, most trades are taken on anywhere from the 15-minute to the 1 hour or 4 hours. So I'd love to, tonight, what I really want to do is obviously get into the markets, have a look at what's going on as well. And when we get to that point, you know, if there's a particular market you'd like me to have a look at, I'm more than happy to do that. Okay, what else? As I said, based in the City of London, trade multiple markets. The main thing that I'm looking for is strong trends, and that's one of the things that we seem to be experiencing at the moment. There's quite a bit of movement in the markets, volatility, and there's sort of good volatility and bad volatility. I think we can sort of kick off and get into that in a moment. All right, so what's on the agenda for this evening? We're going to talk about reviewing Fibonacci retracements in order to suit our trading habits. And then, of course, we want to talk about incorporating Fibonacci, the Fibonacci retracement tool within our trades. We need to talk about how we go about pinpointing buy and sell levels for trade entry, stop placement, as well as take profit levels. And then finally, we need to talk about using and applying and discovering the Fibonacci retracement live in action. Obviously, on the IC Markets platform, we're going to go to the live markets and have a look at what's going on. There's quite a bit, as I said, it's actually kind of cool. Traders really do benefit from when there's more activity in the markets, and I do think that today is probably one of the best times in history to be able to engage in the markets. All right, so what I'm going to do at this point is we'll go across to the platform and then we'll come back to this slide at the end. So I'm just going to go across here to the platform, and what I wanted to do is just give you a little bit of background behind the Fibonacci retracement tool and the logic behind it. So first of all, I am a technical trader. I think that's relevant. I sort of used to own my own business, so I was in the film industry. I was a technical director, so I ran a company, founded and ran a company that focused on visual effects. So very much what you see in all the big movies today, Toy Story or Shrek or any of the animated films or the Marvel films as well, special effects. And it became very competitive, and so I decided to kind of sell my shares. And with the money I had, I wanted to effectively kind of rebuild myself. And so I was probably 33 at the time and decided around 2008 to undertake learning how to trade. All right, so I spent a lot of money on some very mediocre education back then before I discovered Trade with Precision. And there's a gap between when I was a client of Trade with Precision and when I became one of the traders and analysts with the company. The reason I'm telling this is, first of all, to talk about the difference between fundamental trading or trading using fundamental analysis and technical trading. And for me, technical trading has ultimately become the way to go. very much trusting price action. And this is something that can be incredibly difficult to do, to trust that the price action is communicating clearly to us. The market is really telling us what it wants to do. So let's just talk very quickly about the Fibonacci retracement tool. So if I go over to the right-hand side of my desktop over here, you'll see listed amongst the tools that I can choose from. I have got Fibonacci retracement here. I'm just going to quickly select it and just place it on the chart. I'm going to adjust the color so that it stands out a little bit more. And I'm just going to quickly check that that is you. That's what you're seeing as well. Fantastic. Okay, that's what you're seeing there as well. Good. I'm happy. So I find this interesting. The history behind it is fascinating. It was originally, there was a chap by the name of Leonardo Fibonacci who lived almost 1,000 years ago. He was a mathematician, and the story that I heard, which is possibly just an urban myth, is that somewhere around the dinner table, he was challenged to come up with a formula to help calculate how quickly two rabbits could reproduce on an island. And so he came up with what's known as the golden ratio, but also the Fibonacci sequence. And the Fibonacci sequence is relatively simple in terms of its idea. We start off with 0, then we have 1 rabbit, then we have two rabbits, right? So if we add another rabbit, we have 2 rabbits. If we then add a third rabbit, we get 3 rabbits. So if we then add the previous number, so we add 3 plus 2, we get 5. If we add 5 plus 3, we get 8. 8 plus 5 gives us 13, and so on and so on and so on. So the sequence starts to build up. Where it gets interesting is that this, when you think about it, naturally there is a sort of a proportion or a proportionate distance between the values of these different numbers. And if you take 8 and divide it by 13 or 8 and divide it by 5, you start to generate a number that is very close to or bang on 1.618. And so, you know, separately we've got pi, which is 3.14, so on and so on and so on. But also, interesting enough, we have the golden ratio. And so what I really want you to take away from this is not so much what the numbers are per se, but the fact that there are, excuse me, my little dog is chasing foxes and the sun is going down. If it's a problem, I'll close the door. So we'll see. Normally she behaves at this point. And so I've got an office in the garden, and it's a nice warm evening. So I've got the doors open and I'm enjoying the evening. So sorry, otherwise I'll just close the doors. What I really want you to take away from this, first of all, is that these proportions have started to reveal themselves precisely in nature. And this isn't mysticism. I'm not talking voodoo here. These formulas can be found regularly. You can go out and sort of identify them yourselves. They can be found in the way in which plants leaves are grown from the stem, and the way in which the diamonds on a pineapple are formed, the way in which the petals on a rose start to form, the order in which they do, and also in a lot more than that, so the spirals in a seashell, the forks, the splits in a snowflake. And so for fun, after the webinar, obviously not while I'm chatting to you now, but take the time. It's only about 2.5 minutes long to watch this little animated video called Fibonacci in Nature, and it will blow your mind if you're not familiar with this, how these proportions, very precise, very accurate, very reliable, are reproduced faithfully throughout nature, everywhere we look. So it's really about proportions. It has, I guess, to do with strength. I mean, I suppose the way that a beehive has hexagonal shapes helps with the structure, keeps with the strength. There are obviously other reasons why these proportions tend to reproduce themselves in nature. So at some point, some traders decided to see if these proportions had started to reveal themselves or reproduce themselves inside the movements within the financial markets. Okay, so again, I'm not trying to make this into something much more than it is. I'm not trying to make it into a religious type of cult-like obsession with how the market moves, but it does appear that we unconsciously and consciously, because it becomes cause and effect, we unconsciously have these kind of rhythms in the market, this breathing out and breathing in. So if we look at the market and we're looking at price action, it's made up of hundreds of thousands of participants. It's a marketplace, people getting in and out. Some people are selling, some people are buying, some people are speculating on top of that actual movement. So there are genuine people. I want you to remember this. There are genuine participants in the financial markets, people who actually have to physically buy and sell gold. They need it. People have to physically buy and sell sugar. So I know one of the market analyst who works at Mars, and she's responsible for submitting, their analysis on sugar, because they have to buy sugar because it's obviously a product they need to put into their billions of dollars worth of products around the world. And so there are physical people who have to buy and sell these products. There's people who live in Australia who's sending, money to their kids in the UK. So there's a pound Aussie exchange happening. There's people buying stuff on Amazon. So there's exchange money being exchanged. There are companies paying suppliers abroad, banks that are having to exchange and move money over borders. And so there is physically money that has to be moved. And on top of that, there are transactions being taken place. So for example, if traders spot that there's a particular flow happening in the moment, so usually the more experienced traders are capable of identifying that a trend has started, has formed, they will usually attempt to piggyback on top of that. So in amongst all of that, we have the breathing out and the breathing in, even within the trend. And so it's been observed that these corrections, retracements, so if I'm going to grab my draw tools here from GoToWebinar, so I'm just going to quickly color that. So we get these moves. Now, I think before I go any further, we need to talk about, there are only two types of market conditions. I want to simplify ideas here. It's really important that when it comes to trading, the understanding and grasping core concepts and using those as the building blocks on top of which to trade is the way to go. So a core concept, for example, would be that there are only two types of market conditions. A market can only be in one of these two states. It is either not trending, which is to say that it is mixing up its highs and lows. The problem with these types of market conditions is that they are dangerous. If we engage in a market like this, there is a greater than 50% chance that we will lose money, no matter which direction we choose, buying or selling, because no one's in control. The market has reached fair value, and all the really motivated traders with money have generally vacated. At this point, imagine you are a surfer. So you're looking to go out surfing on the ocean in the morning, and you go out and the ocean is completely flat. There's no wind, there's no movements in the ocean, it's calm and it's still, there's no waves. There's really no point in you going out because there just isn't anything happening. And on the other end of the scale, the other end of the extremes is if you go out and it's too stormy and it's too choppy, and you might just be an intermediate surfer, maybe you've only been surfing for a couple of years, it's too dangerous for you to go out. There's no real enjoyment or pleasure or benefit in you getting out there. So that's the kind of conditions that we have over here where it's really, really dangerous. And there's a very high probability when we trade these kinds of conditions that we're very much more likely to actually lose money. So we, as a general rule, we tend to want to avoid conditions like this. That leaves us with the only other remaining conditions, which is a market is trending. Okay, so market can be trending in a very nice smooth fashion. It can be a little bit more choppy. It can be very kind of bullish and moving in an extreme fashion. So any of these type of range of conditions, it can be going to the downside as well. So it doesn't have to be going to the upside. So it's either not trending or it's trending. That's it. So that's any market, any time frame can only exist in one of these two states. Now, if we eliminate markets that aren't really going anywhere, because what we want to do obviously is make money. So we want to make money from markets that are moving. All right, so we need markets that are moving. So we need to eliminate the markets that aren't really going anywhere, that should leave the remaining markets should actually be moving. Okay, and so normally we identify them because we can see that the market is producing a series of higher lows and higher highs. It's such a simple concept. And the thing that that often happens with people learning how to trade on their journey is they overlook the basics. To them, it's kind of like it can't be simple. It has to be complex because it just can't be that simple. And so what happens is people look for complexity when they should really be mastering the basic concepts, the simple concepts, the 1 + 1 = 2. They're trying to do division and all kinds of other formulas when really they're trying to do Elliott wave theory, Gartley patterns, when they haven't quite yet mastered the basics, which is higher time frames and trends, differentiating. And I want you to understand as well that the difference in personalities between a market that has no clear trend and a market that is trending, even though it is technically the same market, it's not the same market. It's like a crazy person versus a sane person, or somebody who's taking 10 shots of tequila. It's not really the same person. So when the market is trending, it is actually much more predictable. It's much more reliable. Its behavior is much more consistent. As soon as it starts to range, it becomes unpredictable. Those are just kind of things that I want you to keep in mind. So the reason I'm telling all of this is that once we have a trending market, we are now kind of obligated. If there's a really nice move, what we want to do now is capture the move. So if you're kind of with me in the way that I'm talking about this, is once I've found a market that's moving, if that's what I want to get in, if that's what I want to engage with, and that's where I want to get involved, then the next challenge really becomes, how do I find an entry? What is a safe way for me to get into that market? And what's a safe way for me to kind of get out? How do I do this? So once I've identified a trend, let's go and do this. By the way, is this making sense to everyone? Is this boring you? Should I leave this or should I move on to other things? Or do you want me to keep going? Give me some kind of interact with me a bit, Jay. Let me know what your thoughts are. Don't be shy, by the way. Yeah, okay, so because I'm trying to kind of lock down core ideas here and what makes it so powerful. And also what I'm trying to do as well is simplify it. Trading is supposed to be logical, it's supposed to be rational, it should be evidence-based, and you should be enjoying it. Not every day is gonna be amazing, but most days should be great. Okay, thank you very much. So here's the thing, I've identified that I want a trend. Now here, the market, the beauty of this, I want you to keep this in mind. And this, I always remember this from a quote. So it comes from, it's a book, I think by Jack Lynch called One Up on Wall Street. Phenomenal. If you guys do want me to give you some recommended reading before the end of the webinar, you need to tell me. Otherwise, I'm not gonna bother you with it, but I'll give you 4 or 5 books that are definitely worthwhile reading. So he said this, and he actually took it from Warren Buffett. He said, basically, there are 2 things that can impact a stock price. He said the first thing are the fundamentals, the book value, how well the company is doing, how much profit it's making, what are its assets and liabilities, what's it actually doing on the ground, how much money is this company making. And the second thing that can impact the stock price is the public's perception of that brand. If the public is not interested in it, if it's printing t-shirts and nobody cares about that, the stock price is just going to be underappreciated. And Tesla is a great example of that. We look at Tesla until, nobody knows this, but until January 2020, nobody cared about Tesla. We knew about it, but nobody cared about it. And then it went and made him the most wealthiest guy in the world, and it literally, that as a car company, suddenly became the Goliath in 2 years. Nobody really kind of pays attention to that. So what I want you to understand, the reason I'm telling you this, is that the true value of a market versus its price on the charts are not necessarily the same things. Okay, so when a market is moving up, imagine these are, you're in the streets in which you live in, everybody's trying to buy and sell houses. So you're watching your neighbor's house price and you're thinking, okay, when am I gonna buy and sell? So what happens is the prices in the road start to go up, and then it becomes a bit expensive, and someone's like, you know, they either sell their property at that price, and then a couple of years later, maybe the prices have started to come down, and now that the house prices in your streets are relatively cheap. So I'm laughing because my wife has just arrived home and the dogs are going nuts. So the next thing is the prices start to go up, and then they become a bit expensive, and everyone's like, okay, we can't, you know, it just runs out of people buying the houses at that price. And you don't know that ahead of time. If in your street, the house prices 5 years ago were 250,000 in London, for example, and now they're 550,000. If I had asked you 2 years ago, would you think 500,000 would be where we are today? You'd have said no. It's very hard to predict where the limits of the market is going to be. It only finds it out in real time. And this is important. Everything I'm telling you here, I want you to apply across the board to all markets at all times. The market is figuring itself out as it goes. It goes down here and then it goes, oh, actually I'm a little bit cheap, and then some buyers come in, they go, I like this price. And then there's enough buyers that come in that the sellers kind of lose interest, and then it starts to pick up momentum, and then it goes up here. But the thing is that it doesn't know when it becomes overvalued until it passes this invisible line that it doesn't actually know. It just goes past it, and then all of a sudden the number of buyers starts to disappear, and the price doesn't go up as much, and then it realizes it's overvalued, and then it goes, okay, well, my true value must be down here, and then it starts going down here, and then all of a sudden more buyers start coming in and the sellers start kind of fading, and then all of a sudden it goes, oh, okay, this is my low price. The point of it is that the market, as it's going, is figuring out where its true value is. It actually doesn't know. The true value runs somewhere through the middle of that. So when we have an uptrend in this example, what I'm looking to do really, ideally, is to offset, is to try to find these areas in an uptrend. The problem is that, and see if you can relate to this. when we're nervous, we want to see evidence from the market that we think something's going to go up. And the problem is that by the time it always starts with small candles here, small candles in the turn, and then they get bigger, and then you get a big one, and then smaller and smaller and smaller, and then smaller, and then bigger, and then bigger and smaller and smaller and smaller. So the problem is that by the time we see the evidence that, oh no, it is going up, it does a really big move, and people tend to get in here. So they get in late because they were nervous. They were looking for more evidence of the market to kind of tell them to get in. And so people often get in at this point, at which point the market goes up a little bit more, and then to them, at least relatively speaking, crashes. And this is where they stress, and they either get out or they panic. Different kind of things happen. And so what we really want to do ideally is retrain our brains and our emotions to understand that a single move up is not a trend. The market is doing this thing, it's figuring out as it goes, and it's actually the collective behavior of the higher lows, of these little turning points. That's actually that's the trend. That's the tide going in or going out, not the individual waves. And so what we're trying to do is we're trying to identify these areas so that we can identify where the market's starting to turn around and ideally get in somewhere there. Okay, so all of this is going to be tied together with Fibonacci. It's going to come together. I'll pull it all together. So the next thing is I'm going to change it slightly differently. The market, this is what's so cool about this. When we have a trend, and I'm just using an uptrend, but this all applies to downtrends as well. We have this point, some people like to get in when the market breaks a new high. That's one way of getting in. As it breaks to a new high, a new stock, for example, and this applies to currencies, it applies to commodities, applies to everything. Then some people like to get in there. But what they don't like to do, the professionals don't like to get in after that. So the very last point, ladies and gentlemen, that traders will get in is when a new high is created, when it breaks an old high. That is the very last point someone will join a trend. So when a stock market creates a new high, that's when a whole lot of people start getting in. The other way that's pretty cool is when the market starts coming back. So if we have a trend because we have high lows and high highs, and the market starts coming back, what we really, when you think about it, imagine you're trying to buy a house in a street you've always wanted to live in, so you're waiting for the prices to drop. You're just waiting. You're like, that's too expensive. It's going for 700,000. If it comes down to 500 or even 600,000, I'm in. I'm gonna make an offer on this house, as an example. And so as soon as price starts coming down, traders start to get in. The ideal spot, ideally, but is very tricky. It's not impossible, but it is tricky to identify, is the swing low, the turning point where price turns here. Some traders are very good at that. But the reason I'm telling you this is that as price goes up, the very last place the market they will get in will be as it crosses this line. That's the very last place they'll get in, because that's when it creates a new high. So what I want you to understand is that as the market starts to turn around, the professionals will start to potentially start to add in their positions. And they'll ideally aim for this one. Some traders will specialize in finding this turning point. And then they'll start to get in here. And the very last place they will get in here. So the reason I'm showing you this is because this represents a box where every single trend trader in the world, no matter what their strategy, is looking to get in. All of this is technically and arguably relevant, like valid. It's a valid entry. Why? Because as price is coming in, you can start to get in anywhere in these areas. The best place would ideally be somewhere along here. That would really be like the best place. As close to the low as possible, but it could be this side, it could be there. And then as it starts to head up again, and the very last place you can get in is as it breaks a new high. And all of those qualify, according to different traders around the world, who are trend-based traders, as the best entry that they like. That's their comfort zone. That's their best spot. But I want you to understand this. What is considered absolutely not acceptable is this area here. So once it breaks past a new high, getting in here up until this turning point over here, none of that is considered acceptable. It's higher risk, because even when you get in and do all of this, there's no guarantees. The odds are really good. If you have a strong trend and you get in on these areas here, the probabilities are as good as they ever will be in trading the financial markets. It doesn't get better than that. These are the ones that offer you the lowest risk, greatest reward, and the lowest probability of failure, but still no guarantee. Something like a 60 to 80% success rate, somewhere in there. You're still going to have 20 to 40% losers. So this is all very important. So all of this, to start to bring it back to Fibonacci, is that these movements, we tend to have these interesting patterns. Sometimes the market likes to come back and it just taps where the old high was, and then it goes on. Sometimes it likes to just do another little pullback, but it doesn't come back to the old high. Sometimes it then goes up and it does a bit of a consolidation, and then it breaks out. All of these are moments where the trend pauses, where there's an opportunity for us to get in where the risk is lower. So when I say the word, when I say the expression, the risk is lower, what I mean is that if the trend is strong, this is going to be one of the nicest places to get in, because the price is going to be very economic. From where we get in, it's more likely to go into profit sooner. And as soon as it goes into profit, we can start to, maybe update our stop loss or take some profit off the table and get to break even. But it's important to understand that the retracements, the proportions, the amount the market pulls back can vary, but it is almost always one of these variations. So I want you to also understand that there is not an infinite number of ways of trading the market. There's not an infinite number of ways of managing a stop loss. There isn't an infinite number of ways of taking profit. There's a finite number of each of those things, and it's less than we think. I mean, there's probably 500 different ways of making money in the markets, maybe a bit more than that. But there's probably only 20 different ways, less than, that you can manage your stop loss. There are a finite number of ways you can do this. There's a finite number of ways of which the market can kind of pull back. Okay, so that's one concept I want to talk about. That I want to add one more thing to that, which is the higher time frame analysis. So when I was getting started, a lot of people in the room, me included, we used to think that, well, if I was looking at the 5 minutes or 1 minute, that was telling me where the market's going to go. And then it took me a while to realize that actually the higher time frame tended to be the leader. So it's kind of like a person taking their dog for a walk. The dog's on the leash and the dog is running around the park, sniffing different trees and different stuff. But wherever the owner is ultimately going to go, the dog is going to follow, even though the dog has effectively got some range and can do what it wants to do. And yes, once in a blue moon, the dog's going to pull you off and you're going to go do your own thing. But for the most part, one of the kind of fixed rules of the physics, the way in which the market works, is that if I am looking here at a higher time frame move, it's almost fractal behavior. If I then go in on a lower time frame, I will see that the lower time frame has a trend within the bigger trend, and that when the bigger trend has a correction, that we will have a temporary or mini downtrend and then back into an uptrend. So the idea that I want you to take away from this is that once we have identified the higher trend, the higher time frame trend, we should really try to find trades in that direction. That is where the market is going to do the work for us. That is the gravity of the market. That's where it's likely to go statistically. Okay, and again, there are only 3 different ways in which you can trade the market. Only 3 different ways in which you can trade the market. If the market is ranging, you can trade from the top of the range to the bottom, or from the bottom of the range to the top. That is what I will call the second best way to trade, to make money trading the markets. It is stressful. It offers from average reward to risk setups to good reward to risk setups, and I would say it's stressful. Then we have, again, I'm using an uptrend, but it applies both ways. And so we have an extension, retracement, extension, retracement, extension, retracement, or an extension pullback, or a push and pull, phase 1, phase 2. Okay, so we have a trend. Now, the third way, which is in my opinion, and I have an opinion that's based on experience, but I'm, maybe controversial, which I consider the worst way to trade the financial markets or any market instrument, is to trade reversion to the mean. A lot of very fancy people with glasses will always come down and say, no, this is a fantastic way to trade reversion to the mean, and then wipe out their accounts. Okay, so there are certain circumstances under which reversion to the mean makes more sense if it's in a market that's largely going sideways, and then you might as well trade the range. So that's where those two will tend to benefit. But reversion to the mean in a strong trend is largely, by and large, suicide. It's an inverse reward to risk ratio. It's not a great way to do it. It's highly stressful because it feels unnatural, because we're trading against the trend. And people say, well, I'm contrarian, and actually the problem is that it just hasn't shown to be a really great way to get into the markets for beginners and for the average retail day traders such as ourselves, who are looking to earn a secondary or primary source of income from engaging in the financial markets. The best way, in my opinion, and there's a lot of evidence to support this, is to trade with the trend, and ideally to capture 50 to 80% of the move. We do not need to capture 100% of it. You can't do that consistently. 50 to 80% of the average move will allow us Okay, we're trading, we're not investing. So we're not holding for indefinite periods of time. We're looking to engage for a fixed period of time, usually 1% risk maximum. Usually, I'll talk about that as well. And usually, excuse me for just sounding annoying with my voice, a 3-to-1 reward to risk ratio. This is, I'm just giving you the kind of large volume stats. Traders, day traders looking for trends, trading with the trend, using a 3-to-1 reward to risk ratio, risking maximum 1%. That's the go-to thing. The 3-to-1 is because the largest big move, average move that the average trade will do will be a 3-to-1. So we're looking to catch fish every day. Some days we're going to catch 2 small fish. Some days we're going to get a big fish and it's going to get off and it's going to go back in the water. We're going to get rid of it and we're going to be up 4%, then close out at 1%. All those kinds of things are happening. But we need a system that will allow us, that we can trust, that every day we're going to be able to get into the markets and capture some money rather than no money from it. And so this is our approach. Okay, we're looking to do that. And so what we're talking about, what all of this means is, first of all, we're ideally looking to trade in the direction of the trend. Once we've identified that, we're looking to find entries into that trend. And that is where we start to introduce the Fibonacci retracement tool. The Fibonacci retracement tool can help us then identify areas where the market is likely to pull back to. Because now that we have an idea, we're like, okay, I'm looking for a pullback. So now we have a trend. Here's a trend. And here's a big tip from me to you. It isn't just a trend. The quality of the trend is the magic formula. Like, it's the quality is always everything, obviously. And what we're talking about tonight is technique. If any of you, it's not as common in the Northern Hemisphere, I find, for everyone to have played golf. But in warmer climates, the average person has at least had a go, I should say, had a hack at playing golf. And one of the things you make the mistake of doing is trying to swing and hit the ball harder, and then you end up slicing it. It doesn't go very far. And what you learn over time is that technique, really about the swing, isn't necessarily about the power. So when we're trading, technique is ultimately the key that's going to help us. And one of the things that gets us 50% of the way to a greater likelihood of making money is picking a quality trend, a strong trend. A strong trend will be made up of very bullish candles. We'll have a look at some good trends at the moment, and the quality of the trend. So we can get trends that have deep retracements. We get those. Sometimes euro dollar does that. I see that a lot. To me, that is not that is like a B grade or B quality trend. What I'm looking for, something ideally would be something that's relatively smooth, what I would call optimal, well-behaved price action. And in these situations, what I'm looking for is to identify a pullback. So the earliest stage, you're saying to me, okay, well, that's all nice, Adam, but how do I know when I'm like, you want to get in anyway in the beginning or the main part of a trend? So how do I know when I can start getting into it? So let's imagine we're looking at a market that's going sideways. We'll start doing this on actual price action soon. How do I know when I can start trading it? Well, there's roughly a range here. So I can't engage in this until the market breaks out to the upside or the downside. And again, this is where I should just give you one bit of background history. When I was learning how to trade, I was in a class one day when I was still learning how to do it, and the speaker, who was a futures trader, who all he did was trade the futures every day. Once he hits his 2,000 pound like target, he stopped for the day. That was just his sweet spot. He traded happy and he was very good at that, and he did it every day. He said, you should see this guy, Nick McDonald's Trade with Precision newsletter. So I did. So basically at the time, Nick who founded this company that I'm one of the traders and analysts with. He was providing a weekly newsletter. We did this market analysis. So you would look at the dollar index and euro dollar and then the global indices, and it was pure technical. And at the time, I remember I was reading in the newspaper. I had biases. We thought Greece was going to default. There were going to be trade wars with China. And it was really hard for me to just trust what the charts are doing, to just trust them. And so I kept trading against the price action and convincing myself that the fundamentals were going to play out. Now we live in a very weird time right now where the fundamentals are kind of making sense, where we have a war going on between Russia and Ukraine. There's wheat is being impacted because it turns out Ukraine is like the jewel in the crown in terms of what they produce worldwide, 40% of the sunflower oil on the planet, and all kinds of amazing things. And so there's a real correlation between some of the inflation prices and the war. We can get that, plus gas coming from Russia, natural gas, all these different things. So we can see that correlation. And with the fear and uncertainty, we can see money moving to the US dollar, and the yen pairs are starting to move, and gold is starting to twitch. So that makes sense to us. But that hasn't been the case for the last 5, 6, 7, 8 years. So as a general go-to rule, day in, day out for technical traders, we're looking at the technicals, because the technicals are really reliable on a daily, minute by minute, hour by hour basis. The fundamentals tend to play out maybe over a bigger, longer period of time. If we trade with the technicals, we tend to be trading in line with whatever the technicals do, whether they're going with the fundamentals or not. That's my case, I submit to you. So if it breaks up to the top side, so usually what happens, it'll break out, come back, it'll retest it and start going. So I would say at this point, we've got the beginning of a trend, and I'm going to include this low and this high. I'm going to include that because we now have that. And so my choice now is to take the very next pullback. So as price produces a swing high, which means that the candles have started to turn, I've got a swing higher, we've started to break the low and come down. I now want to identify an area where I can ideally join this trend and how I can go about doing that. So is everything making sense, guys, that I'm talking about here? Is it of interest to you? So this is the logic. There's a logic and a rationale behind it. Now that I see it coming back, I want to identify these trends. And we noticed that with Fibonacci retracement. So if I start here, this is in an uptrend. We've got a push and a pull, an extension and a retracement. And what we're talking about tonight is the Fibonacci retracement as it relates to the previous move, because that's what I'm looking for. I need this retracement in relation to this previous move. The relationship, the proportion of the distance of this compared to the distance of this. So if this is a 0 and 0 goes to 100, then the retracement is coming back. So the retracement is 0, and if it comes all the way back, it's come back 100% of the way, if we talk about percent. If it comes back halfway, it's come back 50%. If it comes back 618, for example, that's 61.8% as of the way back. So you must understand that when I measure it, when I measure this move to find the Fibonacci levels, they should go from 0 to 100. Because if I go to 100, I've come all the way back. And that's not a good thing. Prices come back all the way to the previous lows. So what I'm looking to do is when I see price starting to turn around, I want to measure from this most recent low to this most recent high to identify an area where price is likely to turn around. And so the Fibonacci retracement tool tends to identify levels in the markets where price is very likely going to interact. So here, for example, if I just bring it up so that we can study it and just talk about it here, for example, I can go over there. Can you see the numbers here? Do I need to enlarge them? Let me just go over here, see if I can. I don't have the ability to do that, I'm afraid. I can't make them bigger. So once I open this up, if I just go ahead and just draw it, I can then edit these color settings. I can change the thickness settings if I want to make them thicker, and obviously I can change them whether they're dashed or dotted. That's a standard feature, allows me to, and this is always going to be dealer's choice, meaning it's always going to be your preferences as to how many lines you want in and how you want them to be. But if we open up those settings, you will see that it's been pre-populated with all these various numbers. Now the only one, there's a couple of numbers that aren't strictly speaking Fibonacci numbers, all right? The 0 is not necessarily a Fibonacci number. Okay, 100 is not necessarily that. That's our measurement from 0% to 100%. And the only other one that I want you to be aware of is 50. 50% is not a Fibonacci number. The Fibonacci numbers are all the other numbers: 23.6, 70.7, 88.6, 112.8, all these different ones here, 61.8, 764. Okay, these are different numbers over here, 1618. These are all different Fibonacci numbers. They're just proportionate relations that have come up. And you could go ahead and look into the science and the maths behind that separately. But what I want you to take away from this evening is that we look at these levels because there are traders out there that look at these levels. So not only do we as human beings, as creatures that have this built into our DNA, literally these proportionate moves that we unconsciously play out at, that it's built into the proportions of our bodies, it's built into the motion, the amount of effort we put into things, it just plays out in everything because of, you know, several million years of evolution. That also these numbers are built, they reveal themselves unconsciously in the markets, and also consciously. Certain traders measure them, and therefore they then play out. And some traders have a lot of money, so they become market movers or market makers, depending on that. And some of the older institutions, some of the traders who came up in the 60s, 70s, and 80s, they have been using this forever, and they've trained their guys. So you get big institutions where these guys from the 60s, 70s, and 80s are now running the big hedge funds. And so they kind of, it is cause and effect. So the main numbers that we're going to focus on today, all right, will be the 0, the 382, okay, the 38, the 50, the 618, and the 100. We're really focused on the 618, the 50, and the 382. So the reason is that most normal, healthy retracements that traders can get in good trends will come back to this area. We could call this the sweet spot. The 618 and the 50 are very, very popular. The 38 as well within relatively strong trends. So the idea is that if a trend is relatively strong, so this would be a downtrend, so the price would be coming down. If it was a really strong trend, it might only come back to the 382 and then it would carry on. Alternatively, it could come back to a nice 50 fib and then carry on down, or vice versa, come back to the 618 and so on and carry on down. These are different, and all of these, that would be a strong trend, would be a 382, medium strength trend would be a 50%, and a slightly weaker trend would be a 618. But price can come back as far as the 618 and still carry on, and that trend is still strong. I would say overall, I would still consider it a relatively strong, healthy trend. So this is what we use it for. So when we have an uptrend, what we're looking to do is to measure it. So I think what we should do is go ahead and just have a look at a couple of these charts. Let's jump across and have a look at a few of these ones over here. And also, there's the time frame difference as well. So if we just, let's just go in here. I'm just going to move in and look at these. So what I want to do is you'll see that I'm always measuring from the previous lows. The general idea would be, for me, if this is coming down, is to measure from the most recent, and this is what I'm going to say, the most recent visually obvious swing low, or the most recent visually obvious one. So there is right on this grid, there is actually a candle here, so there is a low there, and there's also a low here. I would say that these would be our two lows, and if I am stressed about that, I'm just going to measure it from both. So I'm just going to go from both, and I'm going to measure, first of all, from this one up to the high. So remember that what I'm looking for here, ladies and gents, what I'm looking for here is to find price coming down to a level, ideally there, or potentially down to the 50, or potentially down to the 618. And that's what I'm going to be looking for. I'm going to be looking for a price action reaction at those levels in order for price to head off. I could also argue and say, well, listen, hold on, Adam. What about this little swing low here? Price comes up there, comes down there. What about that? So let's do that. Let's measure from the low of that particular candlestick, and you'll see price has come back here, has come back to touch precisely that 50 fib level. There are also algos as well, by the way, that are looking at these price levels. So I just want you, we're taking them in as an additional kind of as an additional confirmation. So we're using this to help us identify potential levels where price will pull back to. If price is going to pull back here and it's going to be a deeper pullback, all right, there is the possibility that it is going to come back to significantly or to a different level. So one of the ones I want to go have a look at is some of these. Let's go and have a look at these as well. You'll see that price here as well, there's a really strong pullback to these ones. So we've got a downtrend in this case. And if we go down to these most recent lows, and again, I find it a little bit frustrating, I can't seem to keep these colors as default. You can see here price pulling back to this 50 fib area and then finding some strong resistance. So in addition to Fibonacci levels, there are core things. If you said to me, Adam, what are the most important elements that What are the bare minimum? You keep saying to me that, you know, trading well is about doing the basics properly, right? It's not about complexity. It's about doing the simple things really, really well. So if I had to take everything off a chart, and this is one of the clues, if you see someone, an analyst, submitting something to a website and it's just layered with just lines and lines and Bollinger Bands and all kinds of stuff, chances are they're an analyst and not a trader. Traders will tend to have simple, clean, clear charts. And really what they're focusing on, the most important element we can start with, so the ground zero, is price action. These are the candlesticks. Okay, so that is the first thing we need. The second thing that we need is support and resistance levels. Support and resistance levels really just make up, they are important because those are price levels. So these price levels that we have, this tells me where the market, just go here, I'm just going to quickly take off my grid. This tells me where the market prices are relevant. This is the area where the fundamental traders and the technical traders overlap. Because the fundamental trader will say, I think gold is too cheap at 1830. I think it should be, I think it's undervalued. I think it should go up to $1,900. And there'll be usually a price level at that. And even then, fundamental traders will identify prices. They'll go, look, that's a really good price for us to get in. So support and resistance levels allow us to organize price action. They allow us to bracket it and frame it and go, okay, well, these are the key levels. This is where price is going to move. Once it breaks to one level, path of least resistance means that it generally will work its way up or down to the next level. That is what happens most of the time. So again, that is a core concept. Once we've got price action and support and resistance levels, we can work out where price is likely to go. If it breaks up and it's trending nicely, probabilities are it's going to go up to that next key level, and we can trade it. We can look for an entry and try to capture some of that move before or by the time it gets to that next key level. If it breaks down, it'll come back and test it potentially and then carry on down to the next level. So I'm telling you this because we're starting to build up a case here. What we're doing is we're starting with price action. We've got support and resistance levels, and now we're starting to add Fibonacci levels to it. And there's this word called confluence. Okay, so confluence is the idea that we look at a lot of evidence to support taking a trade, where we should get in and where we should potentially get out. The fact that we've had multiple touches here, and perhaps that's possibly a strong historical level. You can actually see as we go back here, we can see there's some, you know, there's also some strong support and resistance levels going back here as well. We can actually see that it's been, you know, repeatedly rejected off that level. And if we find that, for example, that happened to be very close to, it's also very close, for example, here to the 618. We can find, when we find that a Fibonacci level, especially in one of these three, is also in close proximity to a major support or resistance level, the probabilities increase that there will be orders there. And we can use this in our favor in a downtrend, right? In a downtrend, most professional traders, unless there's some other reason for them to believe otherwise, will be placing sell orders, which means that at major levels, there will be sell orders or more sell orders than buy orders, more of them. In an uptrend, there'll be more buy orders at key levels. So if price is coming down, there's more likely to be a buy order. So for example, if you're looking at Apple and Apple is coming down, it's having a big correction, there are going to be buy orders here because a lot of billionaires are like, listen, I'm going to pick up more Apple stock at a discount. So I'm just going to have a buy order. If it ever comes down to this, I'm just going to pick it up. So there's buy orders on the way down. And so when we identify Fibonacci levels on the way down, when the market is in an uptrend correcting, we are likely to find lots of buy orders, and they often tend to overlap with support and resistance levels and Fibonacci levels, and we call that a cluster. And so that's what we're really looking to do. We're saying if price comes back and there's a major level there and there's a Fibonacci, and even bonus would be if there's a nice round number, then the probabilities are that traders who don't use Fibonacci but do use support and resistance will place orders. Price action traders will they'll see the reaction of the candlesticks. They'll place orders off that. Round number traders will do their bit, and Fibonacci traders will do their bit. And so the Fibonacci is used to help us find confluence and to find more and more reasons to get into a trend. So what I want to do here is then go and have a look at some of the other markets. So let's go ahead and have a look at, I want to have like one of the ones that I quite like the look of. Let's have a look at JPY. So let's look at pound yen. Some of these markets are quite overstretched. Okay, so we're looking at it over here. We've got the monthly. We can see we do have an uptrend. We can see the market heads away from the moving averages, comes back, heads away, comes back. remember that the moving averages in this case is really there just to tell me the market is overvalued and it's coming back down. You can see a bit of a reaction here at the moment. And I'm just going to take the grid off so that we can see the lines a little bit clearer. And what I'm going to do here is just throw on a horizontal level at this point here. So actually at about 156, give or take, there's a nice level of resistance. Potentially price, this is not an unreasonable idea, potentially price could come down to this level, test it and carry on if the trend is ultimately going to carry on. And it looks like it has. Why? What reason do I have to believe that this market could more than likely continue onward? Well, the fact is it's broken through this resistance and it hasn't been able to get through here since 2016. That was the last time it was kind of above this level. So that's quite significant. The fact that we've broken through it now, if price is going to come down, create a bit of a swing high there, this could be an amazing place ultimately to enter into that. Now, I'm not saying trade it on the monthly. I'm not saying that. I just happen to have spotted that now that we've moved on to that. And I am curious to see if there are any significant Fibonacci levels there as well. So first of all, what I'm going to do is measure from the most recent low to the most recent high. We don't really get anything specifically there. We get the 618 is just above that. So we've got the 382 week, the 50 and the 618 up here, so not really noticing anything there. And I'm going to move it down to the next level there, and then we find precisely 618 overlaps precisely on that level. So now what you saw me do was measure from two different swing lows, and that is acceptable. It's acceptable because on different time frames we'll be measuring from different swing lows, and that often means that if we find, for example, I could measure a second Fibonacci from there to perhaps here as an example. In this particular case, nothing else really shows up. But if it had so happened that there was another Fibonacci level that came on top of the 618, so in other words, what happened was, I ended up getting another level on top. So let's just illustrate this by way of exaggerating it. So let's just say I found something like this, and I found multiple Fibonacci levels close to a support resistance level. That actually then makes even more of a cluster. That creates more evidence reasoning that there are likely to be orders in that area. So the point of this then becomes, I'm going to go and have a look at it also on a lower time frame. Just get rid of that, and let's go ahead and look at this on a weekly time frame. Okay, I'll just go for it up here. Okay, and again, very, very nice to see this happening. I still think that this most recent swing low makes the most sense. And so I'm also just going to go through and measure that. And this is something that I would physically be looking at in real life as an actual trade idea. So I know it's coming down so far. The 50, there's been an initial reaction off that, and the 618 puts it right along the top of these, which is also a relatively decent place for price to come back and test it. So the 618 is also, by the way, closely overlaps a nice round number, 158. Close to a level. So not only what have we done so far tonight, we've kind of introduced the concept of it, the concept of identifying the right type of market conditions and where we should be using the tools, and not in a ranging market, but in a trending market, and what is the importance of these different levels, and also what happens if we measure them from multiple swing lows. So if I measure them from multiple swing lows, I'm looking for reinforcement. I'm looking isn't it interesting if I do happen to find two Fibonacci levels within a few points or directly on top of each other? If they're not on top of each other, it's not too important, but I'm looking to see if there are any Fibonacci levels, I beg your pardon, that line up close to or pretty precisely with support and resistance levels. So these are really good. So what is my approach then? Well, first of all, what I can do then is start to look for how price reacts at this level. There's a couple of different approaches. Okay, so I could be bold, and this takes a little bit of experience, and place a buy limit order here. So I'm not giving you financial advice. This is not financial advice. I'm just giving you this as kind of, we're just having a discussion here about how different traders behave. I could place a buy order there with my stop loss below this level, because if it comes back past 100%, there's almost certainty it's not going to go my way again. I could place a buy order there. And so what happens is this becomes my 1% risk. And by the way, this applies to a 1 minute time frame. Imagine we were looking at a 1 minute time frame now. It would be the same thing. 1 minute time frame, 5 minute time frame, 30 minute, 1 hour, 4 hour, daily, weekly, so on. We happen to be doing it on the weekly, but I'm applying it to that. It's the same logic. So I can place a buy order at this point. What I would usually do is place the buy order just a few points above that, because sometimes price happens to stop just a hair's breadth above where you want and then carry on. And I don't want to miss out on getting tapped in. Price could also dip below that. It could come back down towards the 618 or just a little bit below that and then carry on. That can do it. which is why my stop loss is here. The fact that it might turn in this area is and not precisely at that point is not evident that the idea didn't work at all. What we are saying is that there is a very strong likelihood that there will be an abundance of orders in this area. And as I said, some people will scale in as others scale in. So in other words, you'll start with a few orders and then more traders will come in and then it'll turn around and start to take off. So at this point, that becomes my 1%, and my 3 to 1 is usually going to be further away. And it's nice if I can get, in this case, what's going to happen is I'll probably get 1 to 1 before I even get up here. So that's probably 1.2, 1.3% return on that. Now imagine this was on a 5-minute time frame. So that is one approach, is to place my buy order down at this level and anticipate that the trend will hold, that it will hold, and that price is likely attracted to this area because this is where the offers are, and place my order there and have price trigger me in, place my stop down here, and then have price turn around and head up. That is one approach. The second approach, for example, would be to observe this area, because I know that this is a zone. This whole area is actually a zone, but if I want to be really pedantic about it, the 50 to 618 is a zone. And what I'm looking for here, ladies and gentlemen, is a nice green bullish candlestick. A green bullish candlestick would look like this. Really, really nice. It could be an indecision one. Why? Because the indecision ones occur at the turning points. They love showing up here. This is where they often occur. So a nice little bullish candlestick, ideally a nice small one of these with a nice tail underneath makes it really nice and bullish. Okay, it's a strong push. One of these forming in this area would be a potential signal. And I would then have a different approach. And this is my favorite. Again, it's horses for courses or different strokes for different folks. If I got that nice little green candle, place my entry order above the high of that with my stop loss below the low. Yes, my stop loss can still go here. There are always choices with our stop losses, 2 or 3 different choices, and it impacts our reward. I like to identify the turning points. I'm okay with that. That's my personal comfort zone, but it doesn't have to be yours. Then I look for price to see if that's going to turn. So I'm looking for price to, then the next candle would ideally be a green candle as well, and they would trigger it. The good news for me with this one that I like, and it's a personal preference, is then I'm kind of up almost 3 to 1 by the time we get up to the old highs. So there are 2 different ways to do it. I could even combine the 2. I could even put 0.5% on this entry idea over there, and 0.5%, another 0.5% I could add on if I see the green candle and start to take that profit. So I'm keeping an eye on this and want to have a look. And so the yen pairs, ladies and gentlemen, are all potentially experiencing a similar type of shift. They've all had a really good run. Doesn't mean they can't keep going, but if they do have a bit of a correction, so if we look here and we go over to the monthly for Swissy yen as an example, and this is just currencies, but the similar thing will happen with oil. In fact, it did happen with oil. It happened with oil. It's sort of happening with gold a lot. Here we've got a nice reaction at this major level. Prices produced a swing high. It's feasible that it could come back down to this area or an area in between that. If I change it up and I go through to the weekly, okay, you can see price coming back into the moving averages. I could take that Fibonacci measurement, right? Measure from the most recent low to the high, and you can see price potentially coming back down to the 50 or the 618. This is a good area for it to come back to. It's not bad. I could also measure it again, so I'm going to do a second one. I'm going to measure from this swing low. I really want to get it from this one down here. That's really the one I got my eye on. This is a nice big correction, nice solid big correction before we hit it higher, and this is what I'm looking for. So these are areas where I'm looking for price to come back to. I've got a 50 fib here. There's a 382 and a 618 really close to each other here in this area. They're very close to each other. Again, let's just get rid of this grid. And so not close enough. Let's just have a look. I want to move it, adjust it a bit. No. Okay, so there isn't really a cluster in this case, but a cluster would usually mean that we get 2 that are very close to each other. Okay. And again, that would be the case if we had that. There's a cluster. So for example, here's a cluster of the 50 and the 382 from the 2 different measurements, which means that there is likely to be a series of orders here, and this could very well turn. So if I'm nervous about putting a buy order there, my stop loss below here because I'm scared of catching a falling knife, then I need to just observe and wait until I get that bullish candle or the indecision candle and start to get that confirmed swing low. The pro with that is that I can generally have a tighter stop loss, and therefore I can get into those 2-to-1s or 3-to-1s or 4-to-1s or 5-to-1s a lot sooner. All right, so let's go back to this. So I don't know about you, but to me, that went really, really quickly. And I was trying to brain dump as much experience and real world trading experience as possible into this. And it just went very, very quickly. So there's a question that's just come in. At the beginning of the webinar, you mentioned that I'm a day trader and I work with 15 minutes, 1 hour, 4 hour charts. In your experience, are these the best 3 timeframes for a day trader to identify trades? Great question. And this is my answer. So for day trading, and this is kind of over time, this is what my experience has led me to believe. The 4 hour becomes your direction. If the 4 hours trending up, I'm looking for buys on the lower timeframes. I'll talk about what the lower timeframes are in a moment. If the 4 hours going sideways, I'll stay away from it. If the 4 hour is going trending down, I'm looking for sells. Now, most of my entries, personally, mine are on the 15-minute. If they're not on the 15 minutes, they might be on the 1 hour. So it's basically my entries are either on the 15 minutes or the 1 hour, and on very rare occasions on the 1 minute or 5 minutes. When the market is moving fast, if there's a really clean trend, sometimes with the US indices, when the US opens, it's a 1 minute and 5 minute, but it's moving really, really fast. In order to, if I had to sum it up, I would say that for beginner to intermediate traders, looking for entries on the 15 minutes and 1 hour work really, really, really well. And as their experience improves, so in other words, they could decide, if I get a setup on the 1 hour, I'll take it. But if I get it on the 15-minute, I'll take it. They'll monitor those 2 time frames in line with the 4 hour. If they are more and more experienced and they can handle a faster moving market, then they might go down to the 1 minute or 5 minutes. And so you'll get 2 batches of those types of things. And no one ever told me that, but that is, experience has kind of shown me that you get pockets of traders that they'll do 1 minute and 5 minutes, and the 5 minute for them is as high as they'll go. And then others will do the 15 minutes or 1 hour. They'll look at those 2 time frames for slightly higher time frames. And it's really good for your first 100 trades as a beginner to intermediate trader. When you're looking for consistency, that's what you want to build up your confidence and to just work your way into kind of mastering this. Is the 15 minutes and the 1 hour great? They really, really are. In others, looking for those patterns. And that sometimes you'll see a Fibonacci setup like we're talking about tonight on the 1 hour. You don't have to say, well, I only trade the 15 minutes, so I'm not going to trade it. If you can trade it on the 1 hour and the trend is looking really good on the 1 hour, maybe it's a bit choppy on the 15 minute, but it looks really good on the 1 hour. Trade it on the time frame where the price action is clean and smooth, because that's where it's the least volatile. That's where it's the most well behaved. So look, again, I want to say thank you so much for joining me. I hope you enjoyed this. If you did, you need to tell IC Markets that you want more of these kinds of webinars. And I, by the way, am just one of the traders. My colleagues are awesome. If you get Tamar, you are lucky. She's a killer trader and she trades the US Open for real. So I'm just saying, if you enjoyed it, you've got to let them know that, because they won't know. But I was going to say to you, ladies and gents, I want to say thank you so much for your time. I'm not trying to rush. It's just that we do have to kind of wrap it up, because that's that's what we're supposed to do. If you do have any questions, obviously, please get in touch with the lovely folks at IC Markets. I know they're happy to help you out in any way they can. I love doing this because it's a job and a hobby for me, and my trading takes like 90 minutes a day. I finished all my trading by 8 a.m. this morning. I've had a long day. I've painted the front door. I've done a whole lot of other stuff. So I was actually excited about tonight's webinar. It's great. It's really nice to meet a new crowd of people. And the goal here, my goal here, is to get you to bring trading down to its core, simple basics. You can add complexity later, but start to lock everything down, improve your confidence, start to see consistency in your results so that you know, so you go from, can this actually be done? Can you actually make money trading? To, okay, all right, some people can I do it? And you can. It's a learnable skill, like learning a foreign language or a musical instrument, and they require practice. And tragically, you need to trade to gain wisdom and experience, but you mustn't be trading at huge amounts of money. Trade, because you're gonna make all your mistakes in the beginning. So trade with pennies, trust, like patience, discipline, patience, and look for those right market conditions. Like I said to you today, just focusing on really good, strong market trends like we've got at the moment. Some of the markets are trending beautifully. Engaging in markets that are trending well should produce more winning trades than losing trades. And don't try to get 10 to 1 out of a trade. Get 3 to 1. Take the money, bank it. That's what we do. So it's every day just carving money out of the markets. That's the job. It's the job. So it's not gambling. We're not trying to get a 10 to 1 every day. We're not trying to do that. Okay, I'm just trying to kind of give you a sense of what it's really like. Anyway, I'm rambling. Ladies and gents, it has been an absolute pleasure, and I love the interaction. I really appreciate it. So thank you very much. don't be shy about looking at the higher timeframes. The monthly can give you really good perspective. Even if you're trading the 15 minutes, the monthly sometimes shows you there's a major level approaching that you hadn't noticed, or maybe the market is trending up and you hadn't noticed that, something like that. Just be aware of those things. And Fibonacci levels work on, they apply on all timeframes. So there we go. Thank you very much for attending. That's the last slide. I'm going to end the webinar. It's going to hoof us all out. I want you to enjoy the rest of your evening, please. You're going to sleep very well tonight, I'm sure. And I look forward to seeing you in future webinars. And I want to say again, thank you for your time. I really enjoyed it. I'm going to let you go now. Thank you.